Hello everyone, my name is Tasia Ross, and the Teachback that I'm going to be talking about today is horizontal and vertical analysis. We learned and used this during both financial courses Tour 116 and Tour 125, as well as in our Tour 425 class, which was financial management. To begin, I will first talk about horizontal analysis and what it is used for, how we calculate it, and finally, why it is important. I will then continue on to discuss vertical analysis and the same three topics that you can currently see on your screen. Okay, let's begin. So horizontal analysis is used to compare account balances in a company over a period of time. It can be used on any category in the balance sheet, such as cash or accounts payable right over here, as well as on the income statement, such as cost of goods sold and expenses. One of the requirements is that you must have the account balances of a minimum of 2 years for each category. As you can see on this balance sheet, there are 2 years ending on December 31st, right here and right here. So to show you how to calculate the horizontal analysis, we will first take a look at cash in our assets section. The first thing you want to do is calculate the difference between the 2 years that you can see on the top part of the screen. In this case, the cash was increased by $3,600. Then, from there, you take the differences and divide it by your base year, which is the first year of the business. This shows the percentage change over the years. So for this example, cash has increased by 30%. Keep in mind that they can also decrease, such as notes receivable, which is the one just below it. They decrease by $100, and then by dividing that over the base year, we can see that the company's notes receivable has decreased by 16.67%. I'll now fill in the rest of the balance sheet for you so you can take a look. So what I'll do is I'll now show you one more example, but this time I'll use the income statement. We can take a look at the sales, which is the top one right here. And the difference from 2007 to 2008 was $298,000. Then, by taking that number and dividing it from the base year, which is 2007, which is right here on the right hand this time, it shows that there has been a 24.8% increase. So now that you know how to do horizontal analysis and how to get the percentage changes, I'll tell you the importance of it. By being able to look and see how your company is doing based on previous years is a great way to help drive decision making. It is also a part of trend analysis so that companies can see if there are any significant increases or decreases over a period of time in a particular category. Finally, by using percentage changes, it allows you to see how your business is doing compared to similar companies regardless of their size. I will now continue on to our vertical analysis. It can only be used on the balance sheet and income statement, but unlike the horizontal analysis, you only need to look at 1 year to calculate the vertical analysis, and that's why there's only one column this time. It allows you to see the percentage of a category in reference to other base categories. Although this sounds confusing right now, it will make more sense once we start using examples. So, first of all, we're going to look at the balance sheet. For the balance sheet, the base category that is used is either total assets or total liabilities and equity, which will both be set at 100%. So you can see it right here and here. This is because, as you remember from Tour 116, assets equals liabilities and equity. So they're both the exact same number, which is $1 million in this case. So to see what percentage of your total assets is cash, you would simply divide $100,000 by $1 million, which equals 10%. If you were to compare the two different years using vertical analysis percentage, you can see which changes have been made and whether or not they were beneficial for your company. So I'll just quickly add in the rest here so you can take a look. Now I will take a look at the vertical analysis using the income statement. First of all, we have to decide which category to use as the base number. On the income statement, we can use sales right here as our 100% base number. From there, we can take any category and divide by sales to determine its percentage in relation to the sales total. One of the more useful categories to do this for is cost of goods sold. So for this example, you would divide $400,000 by $1 million, which would equal 40%. And I'll just fill in the rest for you. Knowing the percentage of cost of goods sold can help to determine whether you're making a profit off the product you're selling before any expenses are taken into consideration. You can also look at other years of your own company to see if any areas have increased or decreased and if there's a problem or not. For example, if a percentage of an expense was very high, for example, it could be a sign that the company is not using their resources efficiently and should investigate how they can lower that cost. Finally, using vertical analysis can also be beneficial to compare other companies' income statements to your own and see if you're doing better or worse than your competition. Thank you for listening to my Teachback, and I hope that you now know how to calculate both horizontal and vertical analysis. Thank you.